Imagine this. You walk into a bank. You deposit $10,000. You believe your money is sitting safely in a vault, but it isn't. That same $10,000 is quietly multiplied, lent out, reused, and copied again and again. And by the time it's done, your $10,000 has magically turned into $90,000. No printer, no gold, no government approval. So here's the uncomfortable question. If banks can create money from nothing, then who is actually paying the price? For most of human history, money was real. Gold, silver, coins you could touch. If a king wanted more money, he needed more metal. Limits existed, but modern money has no such limits. Today, over 95% of all money in the world exists only as numbers on a screen. No cash, no physical form. And the shocking truth? Governments don't create most of this money. Banks do. Not central banks, not finance ministers, regular commercial banks. And they do it every single day. Let's simplify this with a metaphor. The water tank illusion. Imagine a village water tank. Everyone believes the tank contains 1,000 liters, but the caretaker secretly gives water slips instead of water. 1 liter of water supports 10 slips, as long as nobody asks for real water at the same time. The system works. Banks work the same way. Fractional reserve banking. When you deposit money, the bank is not required to keep all of it. If the reserve requirement is 10%, you deposit $10,000, bank keeps $1,000, bank lends $9,000. That $9,000 gets deposited again. The bank keeps $900, lends $8,100. This continues. Result? From $10,000 of real money, $90,000 of digital money appears. Not printed, not earned, created. This is called credit creation. The shocking part. Banks don't lend existing money, they create the loan first, and the money appears later. Your loan is created as a number. Debt comes first. Money follows. Every rupee, dollar, or euro created this way is born as debt, which leads to a terrifying reality. If all debt were paid off, most money would disappear. Now here's where the system cracks. The bank run problem. This system works only under one condition. People must not panic. If everyone asks for their money at once, the illusion collapses. This happened in 1929. Banks failed overnight. It happened in 2008. Lehman Brothers collapsed. And when banks couldn't cover their promises, governments stepped in with taxpayer money. 2008, the moment of truth, banks created trillions in loans. Risky loans, fake confidence. When it collapsed, banks were rescued. CEOs got bonuses. Ordinary people lost homes, jobs, and savings. The message was clear. Profits are private. Losses are public. Banks are too big to fail, but people are not. Why inflation exists? When banks create too much money, each unit becomes weaker. Your salary stays the same. Prices rise. You work harder. You save more, but your money buys less. Inflation isn't accidental. It's a feature of debt-based money. Today, the system is larger than ever. Global debt is over $300 trillion. Central banks print money to save banks. Asset prices rise. Inequality explodes. Those closest to money creation win first. Everyone else pays slowly, through inflation, silently, painfully. So here's the truth most textbooks won't say. Banks don't just store money, they manufacture it. Every loan expands the system. Every crisis exposes its weakness. The system survives not because it's stable, but because people believe in it. Money today is trust, debt, and confidence. And once confidence breaks, history shows what happens next. So let me ask you, if money is created from debt, is the system broken or working exactly as designed? Tell me in the comments, and